we talked about the underlying basis for like some of the ideas and the methodologies of what we actually use to make portfolios. So we talked about new portfolio construction theory, which is really just how am I putting investments together to build a portfolio? And they're concepts that we derive from modern portfolio theory and our experiences that we've had working with our clients through time. So for me, those experiences of working with clients is just sort of looking at how do people actually look at the dollars inside of their brokerage account, and how can you sort of how can you represent things that they either believe in or are worried about, and really just make the portfolio reflect what they value and what they're looking for overall. And it's this is how we select investments, and we're just trying to make this as simple as possible, because portfolio building doesn't need to be this big complicated mess. It really is just making sure that you pick things that match your objectives, and you don't need to be good at stock picking. You don't need to do any of these other crazy things. You can have a very simple portfolio that really works hard for you over the years. So the number one thing that we use to select investments is time, because the more time we have, the more risk we can take, the more risk that, actually produces decent returns. Like the S&P 500 is a relatively risky investment, but if you give yourself lots of time with the economy growth and inflation, you will get good returns over that period of time, and it will get closer to sort of those average 8%, 10%, or 12% returns that people might talk about on a yearly basis. And so, right, of course, there is that problem.
We had a lady walk in.
Oh, yeah.
Introduced herself, wanted to meet us.
Yeah.
Had been a client for a long time, we inherited, and she came in with her daughter, and I asked, she talked about her age, and I thought she was like 75. She was 95. We have several 90+ clients. And that's another reason to save this money, because you're gonna need it.
Yeah. And the stronger our liquidity needs are as well, we can't take a lot of risk either, because if we have strong liquidity needs, essentially what that's doing is cramming down the length of time that we have. So we might have a total investment horizon of the next 20 or 30 or 50 years, or whatever the case may be, could even stretch beyond your lifetime towards beneficiaries. But if we have to be paying for lots of expenses in the meantime, we have to understand that those expenses effectively shorten the time horizon for those dollars. We can't take the same amount of risk as we can on the back end. So creating a portfolio is really just looking at these two factors and then understanding how we can use that to help us select risk-appropriate investments. We talked about the law of large numbers in investing, which is essentially just if you're trying to get close to an average number, for example, again, that S&P 500, if you want average returns, you have to participate for a lot of years, because each year is very far off from the average. I mean, we've seen years where the S&P was down maybe 50 or 60%, but we've also seen years where it was up similar amounts or more or less, anywhere in between, or years where it pretty much just came right back to the same place. And so in order to get those average 8%, 10%, 12% returns, we have to participate for a large number of periods if it swings up and down a lot. So insurance companies use this all the time. This is how insurance works. They insure a lot of the same type of risks, so they can understand on average what is the risk that somebody actually files a claim, so they can price their premiums properly and the payouts and all that sort of stuff. So we use this by holding riskier assets for a longer period of time, using less risky assets for immediate needs, and diversifying across asset types. And then we also talked a little bit about dollar cost averaging, which is essentially just buying the same dollar amount of whatever it is you're investing in at regular intervals, regardless of how expensive or how cheap it is, which on average results on you buying more shares at lower prices and less shares at higher prices. It just kind of feels good to do it that way. So we talked about time-based asset allocation, and the really, really simplified way, this is kind of like, this is similar to sort of like the Boglehead strategy, if you've heard of that, where essentially super short-term needs, cash. Intermediate term could be your bonds, and long term could be stocks. So if you were building a 3-fund portfolio, for example, you might put a money market fund up in there. You might put a fixed income managed fund or a bond aggregate fund, and then you might just buy the S&P, and then there you go. So that works, but it's really just an extremely simplified way to understand the process. I prefer to be a little bit more nuanced, just so that I have the ability to move around and be a little bit more tactful, not necessarily about trying to get bigger returns, but just, sometimes I like to lean in different directions. You might have industries that you believe more in or want to have less of, so you can use that we can talk about how we'll accomplish that. Diversification is really important. So making sure that we minimize exposure to any single risk, things like company risks. I don't want my entire portfolio to be reliant on NVIDIA's returns, and make sure that we, are combining multiple types of assets to protect ourselves from those individual risks that we can diversify away. Market risk, we can only mitigate by how much we participate in the market. But company risk is something that we can essentially diversify away by holding enough different types of stocks. We talked about all of our different types of risk, which is really just your unsystematic, the diversifiable risks I was just talking about, the ones we essentially want to make go away. Now, there could be some argument that government and regulatory risks could stretch a lot further than diversification can help. So that's something to also be aware of. But systematic risks are really the ones that we're going to be managing. We want to choose investments that make us not have to worry about unsystematic risk because we have enough holdings to not be concerned about it. But then we want to look at systematic risk, which is essentially just overall volatility, interest rate risk, and stuff like that, and just make sure that we are actually taking the right kind of risks by being exposed to a risk-appropriate level. So today we're going to get into actually using some of these concepts, but then also looking at different types of investors and sort of matching things together. So here we'll talk about practical applications for portfolio building using those two concepts that we just talked about. So when we look at it in the big picture, not every single portfolio needs to have 3 distinct stages, because you could have, each account be a different stage. You could have like all of them build together into one blend. You could just have one account. It really, not everything needs to follow the exact same, philosophies that we're showing here, but it all is part of one big picture. When I say portfolio, oftentimes I'm talking about an individual investment account. You can also look at it as your whole picture. You can include your real estate, you can include bank savings and all sorts of things and put that all together. So knowing the purpose of the account gives us the framework to build a good portfolio. So for me, this is something that I do with my clients who have multiple accounts. So if you've got something like a Roth account, a Roth IRA, you've got a 401k, and you've got a taxable account, you might choose different purposes for each of the different accounts. So instead of trying to get one, big balanced portfolio where everything matches the same, your taxable account might be where you prefer to draw funds from. So you could make that the most conservative choice. It also will reduce the amount of current taxes if you're using things like tax-free income funds, or maybe you're saving a little bit of state taxes with treasuries, versus getting a bunch of growth, getting a bunch of really highly taxable bond interest in the taxable account. You could move those things to other accounts. So for example, for my client, she has 2 Roth IRAs, and that's where we just really take on all the risk. Because also, if we get a whole bunch of gains, that's tax-free because it's in the Roth. So if we take a lot of risk there and we make a lot of money over time, that's going to be tax-free money that we could take. So you can really, I like to segment each portfolio into different goals and say, what is this funding? What is the idea for this? Because it kind of helps me if there's a lot of volatility in one account, but we know that that's earmarked for something in the far future, we don't have to worry about it so much. And we can look at shorter term horizons with other accounts. So we're going to look at some examples for balanced portfolios. So just kind of that right in the middle person. And this is just mostly because this is the most common type of investor that we run into, whether it's at our practice or just people out in the world. when I'm talking about investing, most people are in this sort of risk range because it's just right in the middle. It doesn't give you all of the volatility of the stock market, but it does give you a decent amount of opportunity for inflation protection and growth. So the following asset selection that we'll be looking at is for a moderate investor with a balanced objective that's seeking to distribute consistent income from a retirement account. So just imagine sort of like a person with an IRA and they're taking RMDs. That's kind of the easiest way for me to sort of explain the framework here, where there's income that's coming out that we have to fund, but they also want to keep a majority of it invested and grow it over time. So just kind of as we're looking at assets, understand that that's sort of what we have for reference for our investing. So we're just going to visually go through each of the stages right now and talk about sort of examples. I made this visual just so that it could be a little bit more, you could see it rather than just hear it, so that you can see, like when we're taking dollars from this side over here. So if we're taking distributions, we want to take our distributions from stage one. But if we've got more time and they don't need to be taken out so quickly, they'll go into stage two. And then if it's long term, that's stage three, and we go for our highest amount of volatility. So for stage one, we're talking about RMDs, we're talking about upcoming expenses, or possibly just a volatility buffer. This is a great position to where you go, I just want to put X amount of dollars in, and I don't want to be worried if this is going to explode in the S&P 500 tomorrow. This is a great place to put things like that. We're talking about sort of your most stable investments. We'll get into some examples later. You've got your short to midterm needs, somewhere between the 3 to 7 year mark-ish. A lot of the times this will be if you're looking to generate income but not take on a whole bunch of risk in the stock market. So fixed income funds like bond funds would fit in here really well. Or we're just taking a moderate amount of volatility. Something just kind of in the middle that is getting a little bit of volatility, gets a little bit of growth potential, but isn't quite the same as a full-on 100% stock allocation. And then for your long-term appreciation, 5 to 7+ years, we're kind of getting a little bit out there, sort of like in that range where it's sort of the average recovery time for like large corrections or recessions, sort of that average 5 to 7 years. It gives us the time to come back from that sort of loss and make it up. So we're talking about offsetting inflation. So if we want to make sure that our dollars today can buy the same amount of goods in the future, it's important that we have this part of the portfolio, because this is one of the things that's going to help offset that inflation cost the most. If we're looking to self-insure long-term care, if you don't have a long-term care policy, you're going to need to have some kind of funding just in case. Like, if you completely run out of assets, yes, there are times that the state will help, but it's really important that, especially for maybe the first period of that long-term care, we have cash to pay for it so you can get the care that you need. Long-term goal funding is also important here. Thinking about beneficiaries, if you're trying to leave assets to somebody, thinking about just longer-term goals, period, or education funding or anything like that. A lot of the times that's going to end up in here. So let's just pause for a second and let's think about why we're doing this in the first place. So your portfolio could be a single holding. We could pick a target allocation fund. There's moderate funds out there. There's aggressive funds. There's conservative funds where they'll do all this work for you. There's a couple examples on here. AOA is an ETF that's an aggressive ETF, and it puts, I think, 80% in stocks and 20% in bonds. There's FASIX, which I believe is a Fidelity moderate. And same thing for Vanguard on the end there. Two mutual funds that also, they maintain certain allocations that are not 100% stocks or 100% bonds. And these aren't specific recommendations, they're just examples, but you would do just fine if you picked one moderate allocation fund versus building a portfolio yourself. But the question is, how would you feel? So let me pose a scenario for you. Let's say we have this one holding. We've just got this one big moderate allocation fund, and it drops by 10%. Your pile, your one holding, has now lost 10% of its value. If that's $100,000, that's $10,000 eroded in value. If that's $1 million, that's $100,000. $100,000 of decreased value. while separation isn't necessary, it's a really good psychological tool. Because remember what I was just talking about when I was talking about separating accounts via their goal based on what they're for. If I know that an account is held for a super long-term goal and I see really big stock downturns, I'm not going to be so worried because I've got time for the numbers to catch up. But if I have a separate piece of assets on the side and I see that it has not changed or it's had very minor fluctuations, I can look at that and go, okay, my safety net is still okay. And psychologically, it makes you feel better because after all, what's our end goal in the first place? It's to stay the course through whatever plan we make. It's not about making the best returns over everybody else. It's just about creating a plan that gets us where we want to go and staying with it the whole time. If that 10% drop would make you consider selling out of the fund and like finding something else and then trying to do better next time, that's not the goal that we're trying to achieve. But if we can separate things and we stay the course all the way through, that's the number one thing that's going to get us to our goal, is just not messing with the plan that we built in the first place. Our brains are wired to give more weight to negative outcomes than positive. It's how we survived. It's how we're here right now, because we pay attention to those negative outcomes to avoid them. So people try to do that in the stock market all the time. If you were around for, say, the dot-com bubble, right now probably feels pretty terrifying because it feels a little similar. It feels like AI is having a similar sort of bubble as tech did back in the day, where anything with .com on the end of it just flew to the sky. I think it was pets.com, and they were trading at like $11 a share, and nowadays it's more like 13 cents, something like that. And so we literally evolved to avoid risk. We have evolved to avoid risk, and for when it happens to run away. That's what we're working with psychologically. So if we give time frames and purpose to sections of our investments, it can be easier to understand their place, effect, and their ability to weather the storm. So let's see another example. Let's say now we have our portfolio built into stages. For example, we'll just imagine that each of these is one fund. So in stage one, we're up by a little 2%. In stage two, we've made 5%, but stage three, our stock allocation has dropped by 19.5%. We know that stage one is safe. Our withdrawal money is okay. We know that stage two is doing all right. It's actually made us a little bit of money. But for stage three, those goals that are further out in time, that's dropped by 20%. To me, that doesn't feel so bad. But this is exactly the same drop as the other portfolio had. This is a 10% decline as well. It will look the same. If you look at the account balance, it will be the same decline. But it might be easier to think, okay, well, my distributions are fine, and my next few years of distributions are also okay. It's just my stocks that are really hurting, because it's the same thing that happened in the other portfolio. It's the same decline. It's the same net result. So we're going to look at some examples of assets, but I want you to keep in mind that your portfolio is going to take on its own form. It could vary wildly from the person sitting next to you. That could be affected by how much is allocated to each stage, what types of assets you put in each stage, what your values are, what you think is important to invest in, whether you like value stocks or you like tech stocks or you like this thing, that might affect what you have. So investment portfolios can vary greatly, and it really comes down to what's best for you, what's going to keep you on track, and then what's going to fund your goals. So most references will be to what's considered a balanced portfolio like we talked about before. So take it, but tweak it and make it yours and make sure that it actually fulfills what you want. So stage one, lateral integration, we're thinking like 0 to 3 years-ish, especially if I'm looking at, let's say, RMDs, for example. I'm tucking away a little bit of those RMDs so that when stocks drop, I'm pulling out of things like treasury bills, money market funds, short-term, high-grade corporate debt, rather than my stocks that have dropped by a lot. So these are going to be least aggressive. We're looking for stuff that you can pull out of really quickly, and 1 day or 1 month or even 1 year is not going to produce a big decline. So your distributions are not reduced. We'll dive into the details of each of these investments later, but just focus on the purpose for now. Just think about the general asset class and why it fits where it does. Treasury bills and money market funds and short-term corporate debt, they're all these super short-term debt instruments where the end of the contract is coming up very soon. And we talk high grade as in like high credit quality from big companies that are likely to pay back their debts, so that there's not very much uncertainty in these investments. We're not questioning, is this treasury bill going to ever get paid off? Well, it's only due in the next 30 weeks, so I'm not too worried about it. The money market funds, super diversified investments where the fund company goes and buys a lot of instruments just like these treasury bills and short-term high-grade corporate debt, and even what's called commercial paper, which is essentially like a treasury bill, but in the corporate world. Stage two, the next several years, we're looking at longer term debt securities and maybe some like balanced index funds or value or dividend focused funds, things that don't have quite the same volatility as the growth stocks, as the S&P, but maybe they're your favorite blue chip stocks. You might use short to intermediate term government bonds, which have a little bit of extra volatility because of how long they are. High yield corporate bonds, companies with lower credit ratings that are bound to pay higher interest rates. Preferred securities, which are kind of like a mix between bonds and stocks and also tend to have a little bit less volatility over time. And then you've also got those balanced asset allocation funds. Like I talked about before, you can stick one of these in the middle and you know that you're getting that sort of moderate exposure while still separating things out into stages. For stage three, usually we're looking at stock index funds. Think total stock market funds, or maybe even ultra long government bonds and corporate bonds, concentrated sector funds. So if you really like technology, this would be the place to have that sort of tilted exposure. Individual stock holdings. So if you really insist on holding individual stocks, definitely stick them out in stage three. Don't count on them for your distributions. So all of that's wonderful, but what mix am I supposed to have in my portfolio? How do I even know when to choose stocks over bonds in each stage? Because remember, like we come back, we've got stage two here, and we have both stocks and bonds. Even in stage three, we've got both stocks and bonds. We have multiple things to pick from. So how do I know how much to have in each stage? How do I know what to put where? Well, there's a few things that are going to influence your mix of assets. That's time horizon. We talked about that already. How long until you need the money to spend? Risk tolerance. So I like to think of this as sort of like the emotional piece, like how well can you stay the course through volatility? How does that affect you? So being really honest with yourself about how volatility impacts your outlook on your financial situation, that's really important, because if you can't stay the course through a correction, oftentimes the best returns come immediately after the worst days when we're talking about daily returns. I mean, it was kind of funny. The last time I taught this class, we had April happen. Like that, we had that big correction where things just kind of dropped. It was like 8% in a couple days, and people were really worried about it. And we just happened to be having this conversation about how staying invested is really important. And I think it was like the week before I talked about it, it was like the last day of the slide, like we slid down by several percent. And I said, you know, some of the best days of returns come immediately after some of the worst. So it's really important to just stay the course through the investment and be able to feel each and every day to get you to your average. And then the day after I said that, the market spiked by 10%. And it just kind of like, it was just illustrative that after some of those really horrible days, you can have that pop right back up that just brings you right back to normal. And then we continued going from there. We had a little bit of volatility, but we recovered. Now that was a very short time frame, obviously. Things like 2008 don't take a couple months to recover from, but it's the same sort of principle. Right from the bottom, you would get incredible returns from the recovery and the subsequent growth. Cash needs are really important. Dollar amount of specific needs. So that's why we talked about making sure you have numbers on stuff. So we know how to calculate like what goes where. Upcoming expenses, if you're expecting to have income, those RMDs, like knowing what is that actual cash need I need to fund. And then required return rate. So if we're talking about accumulation, if we're talking about getting up to a certain amount to fund something or leaving a certain amount to charity or other beneficiaries, it's kind of important to know like how much do we need to actually make to a reasonable standard, obviously. I can't go expecting 20% returns every single year, but if I have a general idea of do I really only need to make 3% or 4%, then maybe I can relax off the volatility and make myself feel better and still get to where I want to go. Because you don't always have to make the most, you just need to make enough. So let's look at some examples for different investor profiles, just people with differing goals and differing risk tolerances. So you'll have a very conservative investor, somebody who really doesn't like volatility very much. They have a lot of immediate cash needs. They just really want to earn a little bit of interest and have a little bit of inflation protection. They don't want to take on a whole bunch of risk, but yeah, I want to keep up with some stuff. I want to be okay. Just don't want my dollars to lose value. They might use ultra short term and short term government bonds in stage one and money market mutual funds and call it there. Stage two might be a little bit longer US government debt, maybe government agency bond funds, things like mortgage agencies, and short-term investment grade corporate debt. That might earn a little bit more interest than the ultra short funds. And then for stage three, it might just be balance funds and a little bit of blue chip funds. Super relaxed. Maybe stage three is really small, just enough to protect against inflation and make sure we're actually participating in the economy rather than holding on to our dollar bills and losing to inflation every single year. Because it's important to not do that. That's why it's important to check and see where you have your savings at, how much is it paying in interest, because savings accounts will often be far under 1% every year. And if you can just get the risk-free rate, which right now is around 3.5%, where there's basically no volatility, but you get 3.5% in interest every year, it's really important to make that upgrade and not just decline in value. So we'll have the moderate investor, which has been our reference point going forward. Immediate cash needs, not a whole bunch of them. It's not like we're liquidating half of the account. They want strong yield, good income, and they desire a little bit of long-term growth to keep this going for a long time. In stage one, they're going to use those same money market mutual funds, short-term government debt, and maybe some short-term managed bond funds. Maybe some funds that are looking for a little bit of opportunities within that short-term time horizon. And notice how with the title for each of these stages, we're matching it to each of these things that they desire. So we have cash needs. We're funding those with those short-term funds. We have a desire for yield. So in stage two, that's a great place for us to look for yield. Sort of moderate volatility, preferred stock funds, dividend stock funds, high-grade corporate debt, high-yield short-term bond funds, things that are generating extra income for us. Yes.
What is an example of short-term government debt and what's short-term? Is that
Yeah.
a year, 30 days?
Yeah, so when I'm looking at, I kind of think of like ultra short term as 2 years and less, maybe 2.5. And then short term, I'm looking like less than 5 years for sure. I usually will stick around the 2 to 3 years for the short term range in terms of duration and maturity and stuff like that. But yeah, I don't like to stretch too far out there because when you start having 7, 10, 12, 15 years, that interest rate risk goes really high. So if the government starts raising rates, the value starts dropping a lot. Yes.
If I get an intermediate term or short-term fund that has those maturities, does that mean I can't get out of it?
In a fund, no. So when you're investing in a fund, they'll take on purchasing all the individual bonds for you. And you can sell in and out of that just like you would a stock or a mutual fund. So same sort of thing. For stage three, we're taking care of our growth needs. So we're putting in our stock index funds, we're putting in our sector funds, we might use growth factor funds if that's your thing. And then maybe we're looking at an aggressive investor, maybe somebody like me. They don't have any cash needs right now. They don't need to take money out of it, but maybe they'll keep a little bit in some higher risk bonds. They want just lots of strong growth over a long period of time. We're willing to withstand lots of volatility. That's not a concern. The market can move up and down as much as it wants. We're going to keep contributing and we're going to keep growing that account. That kind of person would probably use your high yield bond funds, or even some really fancy stuff, derivative income funds, where they start using some extra, fancy instruments to generate a little bit of income on top of stock positions or bond positions that isn't normally available, and introduces a little bit of interesting risk profile. But for somebody really aggressive, that might not matter so much. Might even put things like high dividend stock funds in there, because there's no cash needs. There's not going to be any withdrawals. There's nothing to fund. If anything, money's going to keep coming in. And so again, we move over to stage 2, and maybe we're going for a broad growth. We're just taking care of super cheap index funds, maybe some growth funds, get your international funds in there, just really cover the whole stock market and just participate in that economic growth. Stage 3, we might start to have a little bit of fun, get a little speculative, throw the individual stocks in there, alternative stuff, anything maybe like crypto or some sort of currency thing. It doesn't matter. You can stick in some extra things that maybe are higher risk profiles than the rest. Concentrated sector funds, again, things like technology. I mean, I feel pretty good about technology in the long term as part of the world. It's just finding itself more and more places of our lives. And I think the boom of AI just shows that, how quickly that tool was adopted by people. That large language model was just, like, everybody I know has interface with AI now in some way or another. And pretty much every company wants to stick it onto their product. So while there probably is going to be some sort of correction in the short term, I still think, just like how the internet has become a complete staple of how we live today after the dot-com bubble, I think we probably will see something to continue with AI and just technology in a broad sense. So somebody like me, I like to invest in technology because I think it's usually where the future is. So let's recap over what that is. Stage 1, generally we're looking to provide instant cash and stability of assets. So if you're looking to either just fund something or bring the overall volatility down, that's what we like to use that for. Stage 2, we're looking for intermediate liquidity, things in the next several years, modest risk, and intermediate term horizon. So not too far out, but not in the next couple years. And then finally, for stage 3, we're looking for those long-term results while experiencing short-term volatility. This is where we're accepting those day-to-day fluctuations, flying up and down, but we're looking for those long-term results. And then after that, we can look at something that we call vertical integration, which is really where we start looking at, okay, now that I know what kinds of stuff I have in each section, how am I actually choosing some of these assets? So the first thing that we'll start with is sort of showing what's going to go in each level. So we've got 3 stages, and just like we've got 3 stages, we've got 3 levels. So this is where I like to sort of get different pieces in for each stage. We're talking about, in the first level, we're talking about low cost funds. This is where I want it to be the biggest piece of the portfolio. Right at the bottom of that, usually we're looking for the lowest possible cost. So for example, if I'm looking at stage 3, if I'm looking for long-term growth, like, I'm not going to pay somebody like 0.8% or 1% or 1.2% to just buy stocks. I'm going to just buy a total stock market index fund, and it might cost me 0.02%. And even if you're at a place like Fidelity, they've got funds that don't cost anything at all as a loss leader. So if I can bring that overall cost down as much as possible, that's my number one goal, because over the last 15 years, 89.5% of large cap funds underperform the S&P 500. So funds that were attempting to invest in the same type of investments but make more money actually made less money. Well, pretty much 9 out of 10 of them. So in my opinion, unless you want to trust yourself at being really good at picking the one of every funds that happen to equally perform or overperform the S&P, I might be much more willing to just pay much less to just purchase an index fund that does it for me and will get me most of the return that I need. So the base for a portfolio, again, it has the purpose of achieving each stage's objective at as low of a cost as is reasonable. I used to say as possible, but now I say as is reasonable, because there are times where management can create better return for you. Most of the time, it's not in stocks. Usually it's with bonds. So that's one thing that I kind of like, I think is always interesting, like when I'm thinking about sort of the Boglehead strategy, where it's buy the cheapest index funds that you possibly can. And I just have sort of one thing to offer against that, which is usually with fixed income funds, because if you look at the return of the aggregate bond index over the last 5 years, it's pretty much exactly where you started from about 5 years ago, maybe down 2% right now. And that's accounting for dividends reinvested. We're not ignoring dividends. We're not just talking about the price of it. The price is actually down substantially since then. Versus a lot of managed funds that I like to use in portfolios are up by 10 or 15 or 20%, some more, some less, just depending on what they invest in. So I say this is reasonable because we don't want to just give up return for no reason if paying a little bit extra, a couple, 0.5% or 0.25% gets us more. So we're seeking market exposure across the board. The one thing that we do want for sure is diversification. I don't want to be too concentrated in any one place. Like John Bogle says, I do like a lot of things that he says, don't look for the needle in the haystack. Just buy the haystack. Just participate in the whole thing. We don't need to find the one stock that's going to do the best. We don't need to find the one bond that's going to give us the best possible returns. We want to stay diversified because, again, we don't want those individual investment risks. We don't want those unsystematic risks. That's a thing that we're just not trying to manage. We're not trying to be fund managers. We're trying to be, retirees or just people out in the world. We're not looking for this to be our job. We want this to support us in living our life in whatever way we choose. So we're seeking funds that have little unsystematic risk or diversifiable risk. And usually that'll happen by having just a really high number of holdings. Strong emphasis on low cost. Again, we're willing to pay for value. Call back to what I was talking about with fixed income funds. But there's no sense in tossing extra money out for similar or even less than performance, which is what I'm talking about again, because fees often are the number one thing that pull results down. That's why it's important to understand like what you're paying for. So if I'm paying for a stock fund, I would really hope that they do better than the index that they're comparing against if they're going to charge me 1.5%. But if I can look at the charts and go, if I added that 1.5% back, I'd be pretty close to that other line. It just doesn't really seem worth it. So a couple examples that we could use in a place like that. Number one is a fund by the ticker FSKAX. This is a total stock market mutual fund from Fidelity with a fee of 0.015%. So it doesn't matter if you're with Fidelity or if you're with somebody else, this fund will barely even cost you 0.02%. Basically nothing. If you compare it to the index it's tracking, the performance will be almost exactly the same. And it holds over 3,850 individual US stocks. So that's really just taking care of that diversification thing for us, right? Like we want to get from one stock that has the highest company risk and down to 10 gets us a little better. 100 is really good. 1,000 is amazing, but 3,850 should probably take care of most of it for us. The one caveat with that is most of these total stock market funds will be what's called market cap weighted, which means the largest companies, the companies that have the largest footprint in the economy, are also going to have the largest positions in these funds. So while it may not be 20% or 50% NVIDIA, there's probably going to be a significant holding of NVIDIA in a fund like that. Next, we've got VXUS, which is an ETF from Vanguard. That's a total international stock index, and it only charges 0.05%, which again, like, ooh, it's a little bit higher than 0.015%, but it's still like not even 0.1% per year. So that's a low cost, and it holds over 8,600 individual non-US stocks. Again, it takes care of the diversification for us. when we use these as our largest holdings at the base of our portfolio, the diversification is not even a question because we allow these funds to take care of that for us so that when we begin to add things, all that we're doing is playing with the concentration and sort of the values that we're looking for. Next from that is SCHO, which is a short-term US Treasury ETF from Schwab with a fee of 0.03% and almost 100 individual notes. That doesn't sound as big as 3,000 or 8,000, I understand. But when we're talking about short-term US Treasuries, it's kind of just 100 of very similar things. So for the most part, that sort of, because we consider US debt to be almost guaranteed, it's weird. The regulations allow me to say that word, but even I feel uncomfortable saying it about government debt. But they're just so low risk in the long term. They fluctuate so little that we don't need to diversify against each individual treasury bill that heavily, especially when it comes to short term, because they just don't fluctuate very much. Next, we have VBTLX, which is a total bond market index mutual fund from Vanguard with a fee of 0.05% and over 17,750 individual bonds. Again, we're just taking care of that diversification. We're making sure that the base of our portfolio just participates in the market, feels the growth of the economy, and provides for our cash needs as it needs to at a low cost, as you can see for all of these. If you put a portfolio together with all of these different funds, you still would not have a total expense ratio over like 5% of 1%, a super, super low cost, which is again why we bias towards that. Because like I said, fees are the number one thing that will usually drag your portfolio performance. So if we can get the cost down as low as possible on the base investments, that gives us a really good chance of getting really efficient returns and getting really cost-effective returns over the long term. Now, yes.
Your funds and you're paying them the standard, whatever that could be.
Yeah.
Are you saying that you might give some of those funds away from their management and get fees?
Well, yeah, so
Right.
yeah, so I think it kind of depends on what the value you're getting from that is. I think it's important to look at if you're paying a professional a fee, you want to understand what you're paying for. So if we're talking about, it's hard for brokers and advisors and portfolio managers to really deliver on outperformance. It just hardly ever happens in terms of, buying stock funds and bond funds and stuff like that. But if they're taking care of your needs and they're creating a portfolio that gets you to your goals and you don't have to worry about it, and that's worth the cost, then that's totally fine. But if you feel like you can handle it, that fee differential is going to add up over time because it's very infrequent that an investment advisor or an investment broker is going to outperform any portfolio that you can build yourself. It just doesn't really happen very much except for the fixed income space. So I think there is definitely return left on the table by paying the fees, but at the same time, it's just considering, do you want that value that you get from that, or would you rather just build the portfolio yourself? I think that's really where you have to kind of weigh it. So we're going to take our break really quick before we get into the next couple levels, but that kind of gives you a base idea of how we're going to go into building a portfolio. So after this, we'll start talking about some of the more concentrated sections that we'll start layering on top. But let's take a few minutes. We'll be back at, a little bit after 50. So yeah.
If you see a broker or an advisor doing things that have you in high cost funds, you're going to be suspicious of, wait a minute, why do I have an average expense ratio of 0.90 when I learned that there's much lower cost funds there? And so some advisors are encouraged to maybe use higher cost funds for various reasons. So this is why you're here, which is great, because a broker or an advisor should be looking out for your benefit. And if they charge a fee to manage the money, in our opinion, they should try to keep you in the lowest cost funds unless there's a reason for a premium fund expense. And you're learning that, and that's fantastic. You won't be taken advantage of, or maybe let somebody make mistakes.
All right, looks like we got everybody back. So let's get into it. So now, okay, before we start, I just want to mention one of the handouts that we gave out. So all the stuff that we're doing, we made a little handout that just kind of goes over each of the sections and some stuff that you could put in here for something like a balanced portfolio. It doesn't call out specific funds because I didn't want to say that I'm endorsing any individual product, but it just talks about sort of basic asset classes and asset types that you might use. So if you want to use it as sort of a guideline, this could help you evaluate your portfolio or build a new one if you're looking at doing it. But now we're going to talk about level 2 of our sort of diversification strategy or, allocation strategy. So the midsection of our portfolio has a purpose of generating exposure to more targeted investments in both equity and bond categories. So this is where we start to narrow down from index funds, particularly if you have convictions about certain parts of the market, or if you have certain values that you want to invest alongside with, or if you just have a certain style that fits better for your personality, or if you want to have lower volatility or higher volatility. You can make a lot of changes in here. So things like factor funds and sector funds fit really well into here. Because you can imagine you can have something like you want to start with the total market index fund. You get the one from Fidelity or iShares or Vanguard, doesn't matter. You take care of the total stock market, and then maybe you're really interested in technology. So you layer a technology sector fund on it to increase that exposure. Or maybe you want to diversify away from it. So you put, more value funds on there, or utilities or consumer staples or whatever else might be the case to sort of pull you away from that concentration. So if you've ever heard of the word tilt, this is where I apply my tilt. This is where I'm putting in my tilt towards value, or my tilt towards tech, or my tilt towards utilities or energy, or whatever it is that you want to be invested in. This is where I'm going to apply that tilt, because I've already covered sort of like most of the job, the diversification, the broad market exposure, the general performance. We've already got that. So now I'm willing to start getting a little bit interesting with my my allocations to fit my personality or the clients. So here's a couple examples. Number one is FELG, which is a large cap growth ETF from Fidelity. It charges a fee of 0.18%. Still pretty low. Notice I'm not picking ridiculously high cost funds here, even still, that uses quantitative analysis to assist in choosing stocks for growth. Now, I just want to make sure it's very clear that you understand I did not put any of these here because they are the ones I would tell you to pick, or they've outperformed by some measurable amount. We're just showing you examples. It's up to you to go look at any of these or anything like them to see if it follows what you want to invest in with your strategy and your risk. So they just try and use whatever quantitative analysis method it is to try and choose stocks that will grow more than other stocks. They'll probably use like the S&P or some other stock index and go, I'm going to look at this, and then based on a couple different things that I've determined, these attributes about a company, I'm going to filter it down, and that excludes all of these companies, and then I have this list left to buy in. And so it's usually a relatively passive strategy, because this is what you would call a factor fund, where they filter down the list that they're given by some measure of attributes, and then they just invest in that list and check on it every once in a while, rather than actively selecting every single individual holding. Next is a high dividend stock ETF from iShares with the ticker HDV. It charges a fee of 0.08%. Again, not super high cost, but pretty much all they're doing is they're looking at whatever index they choose, a Russell index, an S&P index, total market, whatever the case may be, and then just applying a filter of going, I want it to be a dividend higher than whatever percent it is that they determine. It could be 1.5%, 1%, whatever they consider to be a high dividend. They're just going to filter for that and place those in the fund. Next up comes ticker FUTY, which is a utilities index ETF from Fidelity with a fee of 0.084%. Again, I'll mention it every single time. Relatively low cost. We're not just throwing money at high cost investments. We're choosing things that are within what we want, but low cost. So we're not paying a ton of fees. Again, same sort of thing. This is what's called a sector fund. They're basically just looking at, okay, we're zoning into the sector of the economy. We're not investing in all different types of communications and technology and healthcare. We're just focused on utilities. So if you like to tilt towards an area like that, you might use your total market index fund and then slap a utilities fund on top of it. And that tilts you a little bit more in that direction versus just what the total market has. Next, we have IWS, which is a mid-cap value stock from ETF from iShares with a fee of 0.23%. So this is kind of like doing two factors at the same time. One, we're looking for the mid-cap stocks, so we're looking for stuff in that middle range, and then we're applying a value layer on top of that. So from those mid-sized companies, I want ones that have lower price to book, price to sales, price to earnings. Just the stock price is not very high for the financials of the company, usually is what value means. So some sort of fundamental analysis where we say this company has, is a good value for what you're buying. A lot of the times that will mean dividends or how much net profit it's generating at the end of the day versus its stock price. So level 3 is where we get to the very smallest little portion of our investments, the little ones at the top. The very top of the portfolio has one of two purposes in general. One would be taking higher risk than we would take overall in whatever section for opportunities that we're looking for. We might be looking for a high risk investment in our stage 3 investments, some managed stock thing that we think is going to be, that's going to outperform, or benefiting from long tenured management experience in a sector or asset class like fixed income. So for example, there's some really good managed bond funds out there. There's a couple that we use in our portfolios where they have done really well in the market because their managers have been through many market cycles. They understand how things fluctuate and they're good at managing their bond portfolio. They're able to manage risk well. So oftentimes I'll use something like that. So we're willing to pay for higher fees, either for super particular strategies. So you might have some complex stock investing strategy, some derivative income strategy where they're pulling off extra income from the investments, or just management teams that have been around for forever that just keep performing super well compared to their index. That's one thing that I'm willing to pay for. Again, it's when you're paying those fees, it's what are you paying it for? So if they genuinely are outperforming their index, or for their risk level, they're getting really good returns, or they have really good downside protection, if there is actually a benefit there, I'm willing to pay the fee. But if there's not, I want to buy the index fund. But again, these allocations stay small. They stay small up at the top of our portfolio. So if they underperform really bad, if you happen to pick the managed stock fund that was part of the 9 out of the 10 and maybe was kind of towards the bottom end of that and just really did not do as well as the S&P, it would be okay because the impact would be relatively low. It just would not be that big of a deal dollar wise. But if they do amazing and they make some extra money, they get some better returns, we're able to add a little bit of extra return to the portfolio, or maybe we add some returns that are non-correlated. So they happen in sort of a different way. They go in a different direction. But again, we're keeping it small because we don't want to allow any management team to make a mistake that impacts our plan on a significant level. I just don't want that impact for your plan. I want you to remain successful. And the most successful, probability-wise, is to be in the index funds, to pay that low fee and get that broad diversification. It's just the numbers support it. So let's look at a couple examples of things that could be up in that top layer. Again, I want to stress, I'm not showing you these because they are the best funds for you to pick. They're just examples of things that kind of fit in that category. So number one is PRWAX. This is from T. Rowe Price. It's an opportunities fund. It just invests in stocks of all different sizes, from the giant ones to the tiny ones. It doesn't matter. They're investing in all different sizes that, in the management's view, are the fastest growing or have the greatest growth potential. Now, notice, in the management's view, this is where you start getting very subjective. These fund managers are the ones making the choices. It's not some quantitative analysis that's the same every single time. It's not a factor fund where they just filter an index. No, these fund managers really do go pick the individual investments, and then it's on them to make the returns. So it charges a fee of 0.79%. It's high, but maybe the performance is there, maybe it's not. It's important to check and to see. It does outperform a lot of funds in its category, but let me remind you what that category is. That category is the one that underperforms the S&P 9 out of 10 times. So if you're outperforming a category that historically underperforms an index, that just doesn't really mean a lot to me. So it's important to contextualize those comments and see them compared to each other and understand what things really mean, because they'll use that for marketing all day and all night. They'll go, hey, compared to all of our Morningstar categories, we're the top dogs, and they still perform basically exactly the same as the index. So it's just like there's not a whole lot of value there, but they'll love to say that and use it for marketing. The next one, PIMIX. It's PIMCO's income fund, and it outperforms most multi-sector bond Morningstar category peers and is well regarded by the analysts. That's basically the same thing that I just said about T. Rowe Price, except most of these peers actually do outperform the bond aggregate index in terms of total return, because that index just kind of stays stagnant. There's not those long-term bonds can get reduced a lot in value. So since I think like 2022, there was a big bond value reduction, and it just hasn't quite returned back since then because the interest rates have stayed pretty level. They haven't made a lot of changes. They're just now starting to make those changes. So if rates continue to be cut, we'll see those prices start to return, but remains to see if that's how that's going to happen. So they charge a fee of 0.5%. But if you look at that return, even net of that fee, compared to the bond aggregate index over 5 years, forget about it. It's just they're so much more return. Now, the thing to be aware of is that they might return a lot more, but you have to understand that that's probably going to come with more downside risk as well. So it's important to go back and look at my analysis software calls it a stress test, and will essentially pick some of the worst times in the stock market or the bond market and see how did it drop in comparison to its category peers, in comparison to its index. Like, what does the downside look like? When things go bad, how bad did it get for this fund? And it did see a pretty strong decline, but it recovered really strongly and continued to outperform. So it's one of those areas where it's important to understand what stage you're putting these funds in, because you would have needed to suffer a little bit of downside risk on this fund in order to get the outperformance. So again, that location is important. After that, we've got ticker ROBO, which is Robo Global's Robotics and Automation ETF. I don't remember when this came out, but it was a few years ago. But they invest in stocks of robotics related and or automation related companies. Now notice this is a very, very niche concentration. You know, we're getting to the weeds of like what the category is here, which is why we put this up in level 3. It's not just a technology till. That's a much more broad and much more diversified thing. This is all the way down to companies that invest in robotics. That's a much more concentrated and a much more undiversified or diversifiable risk. It's something where, you know, there's a chance that robotics may not take off, but then AI just goes flying. So AI did really well. Technology overall is doing good, but robotics may not be having the same sort of increase. So kind of important to weigh that and understand how long you may need to wait for that to pan out. And they charge a fee of 0.95%, which that's on par with a financial advisor or financial planner who's providing you with an entire plan, who gives you, you know, regular consultations, and you're just paying that to the fund. People you're never going to talk to, you're never going to have a single conversation with. So it's just understanding, like, what are we paying these fees for? What is the value that we're getting out of this? Next is ticker JEPI, which is a fund, an ETF from JP Morgan, which is an equity premium income ETF. This is what I'm talking about when I talk about derivative income. This is where we get a little interesting, kind of hard to explain unless you understand the underlying investments and instruments in here. But they use individual stocks. So they'll use, whether it's blue chip stocks or S&P stocks, they'll build a nice little portfolio of individual stocks. And then what they'll do is they'll sell call options, which are essentially contracts that allow you to buy a stock at a certain price, by a certain date. It gets complicated, but they sell these contracts on top of the stock and it generates extra income. Now that sounds really great. It's like, oh, cool, free income. Now my dividend rate is like 6, 7, 8%. That sounds really nice. But at the same time, those options that they sell, essentially what happens is if the stock rises by a certain amount, the contract holder goes, huh, well, now it's at 25. My contract was to buy it at 20. I would like to exercise that now, please. And then the fund has to sell their shares, not at the current price of 25, but at the price of 20 that they agreed on previously. So it caps upside potential. You're not going to get all of the growth that you would by just holding the stocks in there. Now, they do some interesting things to try and make the return profile a little bit different, like using derivatives, like maybe buying an S&P call option themselves to increase their leverage, to have more long exposure while they sell these options for income. Now we're getting into the weeds, but they charge a fee of 0.35%. So again, it kind of just depends where you're putting this. This could be an interesting sort of moderate volatility position where you're technically still invested in the stock market, but you're getting a little bit of extra yield that could pad the downside, but also limits the upside. But depending on sort of what the market conditions are, if things are kind of flat, if stocks are not rallying constantly, if they're flat or just slightly going down by a little bit, they're not going to have to sell those stocks out with the options that they're selling on them. So it might be generating some extra income and actually making that sort of flat level of return not feel so bad because you're generating more income. So I just like to pull up one of these after we talk about each of the different stages, just so we kind of have a little bit of frame of reference for these long-term returns. These are a bunch of different things. We've got down here in gray is inflation. So this is just the cost of goods increasing, the purchasing power of your dollar decreasing. We've got treasury bills, which is this green line right up here. So you see, if you don't want to be killed by inflation, at the very least, consider treasury bills. And then you've got your long-term government bonds up here, which do get a little bit of extra return. You've got your large stocks and then your small stocks. So since 1926, Small stocks have dominated every single category. But at the same time, there's some pretty significant downturns. And even like as we start, like the first thing that happens is they drop by, that looks like pretty close to 80%. That's a really strong decline. That may not be within your risk profile for your investment plan. It's really important to consider that. So it's nice to see that shiny number of $49,000 versus $22. But you understand that those treasury bills had a very smooth line of return, very comfortable, not a lot of volatility, just kind of moving along smoothly, not really even worried about what else is going on there. But even the long-term government bonds have their own periods of volatility. Sometimes they drop too. This 70s and 80s, drop a little bit here. It's really small in this big long chart, but if you're existing just right here, and that's all of your context, that might be a lot of volatility. So it's like, I always zoom out to show, hey, look, that volatility is probably going to work out in the long term. But then at the same time, you have to understand how maybe this decline is going to feel. Because this is, let's see, 2021 and 2022. This was like that last really big decline that we saw in both stocks and bonds. Both of them just, you can see it up there. It looks so teeny tiny, but that was like a 20 or 30% decline. On this big chart, it doesn't even exist. But if you were invested during that day and you looked at your accounts, it was really scary. I mean, even just diversified target date funds or target allocation funds were down 30 to 40%. And that was pretty recently. So the takeaway is creating your customized portfolio requires allocating properly for your needs, as well as diversifying between different funds and fund companies. We like to use different fund companies because we like to have some diversification where our management teams are from, or one of the things that he likes to say often is if, say, Vanguard got hacked, for example, I've got my Fidelity on the side and I'm okay. I've got Schwab, I've got T. Rowe Price, I've got PIMCO. I just like to diversify between companies because I want to have the best that everybody has to offer. For the low cost, I'm just going to pick who's got the lowest fee. For the management teams, I want to really look for those companies that have a really good track record of having good management over time, that have long tenure, that haven't completely replaced their management team maybe in the last couple of years, people that do not have experience with those other market cycles, because that's also something to be interested in. You might have a managed fund that's done really the last time, but then all those managers just retired and they just got replaced by the new young team. They might do great, but they also might not have been around for the market cycles that guided the investment philosophy of the last team. So even when it comes to managed funds, even when it comes to just the managers in there, it's something we have to look at. We have to really look deep at what we're picking for our portfolio. So to address these needs and timeframes, we use lateral and vertical integration concepts like we showed you today. Each portfolio is going to be unique to the person and the person's needs and risk tolerances. It's really important to understand that your return might differ a little bit from your neighbors. Your portfolio holdings might differ a little bit from somebody else's. And just because somebody else made a whole bunch of money or is just like has a better return, it doesn't mean that what you're doing is wrong. It just means that you're doing something different. Lower returns don't always mean worse. Sometimes that lower risk is what you need to stick through that plan. Remember, I talked about the most important thing that we want is for you to stick with the plan, because most of the plans that you could build are going to work if you actually stick with them. Consistency is the name of the game. Consistency is what gets you there. But if you're doing this thing where you're invested above your risk tolerance and then a decline happens and you out and then you reallocate to something else, and then you're at a lower risk now than you were when the stocks dropped, so you don't have as much gain potential to come back. If you start changing things in the middle of volatility, you usually end up handicapping yourself. I like to mention a statistic frequently where people who were with financial advisors versus those who were not generally had, 3% better annual returns year over year over time, not because of what was in the portfolio, but because the financial advisor wasn't so easily spooked to sell during a downturn. That's it. That's pretty much all of what that was. Yeah, it's good to be allocated for risk and to be willing to take on the right amount of risks, but it really, most of it is just not panic selling and just continuing through because you know that what you developed previously prepared for that. So prepare for it, but then when it hits, don't change your mind. Follow through and keep going with the plan that you put together. So with that, yes, I was just about to say questions. Go ahead, please.
Fund manager.
Yes.
Like just picking any,
When you talk about the fund managers, just picking any one of these, like for Robo, I'm just curious. I'm picturing one person. It sounds like it's a whole team.
Yeah, usually
What are their backgrounds and how many fund managers does it take to manage a Robo type or a PR Wax type account?
right. So that's an interesting question. And it would be hard for me to answer, like, what does it take to manage the robotics fund? Because I don't know anything about robotics, but like weirdly, I'm gonna have to know something about it so that I can pick the right manager. But let's just say, for example, I'm just gonna pick like this one here and see if I can see where's the managers? Where do they do this? Let's see. I just want to see if I can find something really quickly. Here we go. Morningstar has a nice page that just says people on it. And if you go there, you can see the management team. So you can see, for example, on this team here, they've got 3 different managers. You can see the timeline of when they've showed up, but you can see that each of these people have been through very different market cycles. This guy all the way over here has been here since 2007. So he's probably experienced a lot of turmoil in the market and has a little bit of clue towards that. We've got Alfred here, who's been here since 2013. He's experienced 2020, and so has Joshua. So they have a lot of experience. They have a lot of time. They have a lot of, they've been in the industry. And like you said, it's important to know that we probably are going to want to know, especially on the smaller funds or the funds that we're not so certain about, we want to know their background. For newer funds, that's really important because if you don't have a track record, like you do here, for example, this fund has a very long track record. And since those guys have been on the fund for a long time, I can safely say that a lot of this is due to them. So let me see if I can get all the way back to
Mathematicians?
probably a little bit of all of that.
The nice thing about the bond,
Oh my God.
you predict the stock market, you're trying to get the best price bond with the best characteristics for the portfolio. So if you were buying supplies for a builder or farms, and you're really good at getting the best price and the best situation. So they're not trying to predict someday people will love bonds or not like them. They're just trying to buy the best setups.
Yeah, so again, this is one of those funds where it's just kind of like here in the orange, we're comparing the US aggregate versus PIMCO's income fund. Now, you can see that when they started, they actually underperformed by a little bit. Their volatility is higher. You can see this right here, a really strong drop, something that you'd have to stick through. Relatively short time frame, but at the same time, the bond aggregate index did not drop by nearly as much. See if we can maybe grab that view in there on the 5-year. So here we go. We can see, I always mention this 5-year period because it's still, the bond aggregate index is still down by 2% over the last 5 years. 5 years with all of the interest of these bonds reinvested versus the actively managed fund is 23.5. Again, that downside is going to be much stronger. We can take a look at that actually with this chart on Max. So yeah, there's some situations where this fund dropped by a lot more. You can see it right here. The PIMCO fund dropped by 11.5%. The bond aggregate index was down at its most by 3.75. So not quite the same. Same thing right here at the bottom. The PIMCO fund is down by 9% versus the aggregate's down by 2.6. But over here, they manage their risk better. And it's just like, you just have to be looking at what are the trade-offs. This is what the managers have been able to achieve. Is this what you want in your portfolio? If we look at something, I'm actually curious. I'm gonna look at that robo fund and I wanna see how they've done so far.
That PIMCO fund would buy. The PIMCO fund would also buy other debt instruments like student debt or vehicle loans, things like that. If they bought them at a massive discount and they could see that there was really good earnings and it reduces the risk, they're going to be a little bit different than an index. They're going to be more aggressive, trying to buy better deals. And if the market drops a lot, then everybody questions, are those cars going to be paid off? What about the student loans? And they're more volatile on the way down.
Yeah, so here we go. Here's the performance chart for that robotics fund. Since 2014 looks like when it was opened. 2018, it definitely did pretty well. In 2020, it looks like there was a lot of hype for these things. And then they traded a little bit sideways for a bit. It's still a positive return, but that super cheap index fund, S&P fund that would have cost you not even 0.03%, did 50% better. Literally a nominal 50% increase, 172 to 230. So again, it's just kind of like, even when it looks like, oh, things are going to go really well, things didn't pan out so great right after that. This was that big correction. We even saw that in the fixed income funds. Came dropping really far and just hasn't really caught back up. I think small caps have done sort of a similar thing. But any other questions on anything that we've talked about today? Okay, well, before I let you go, one thing I want to talk about is our other handout that we had for today, which is just, it's a cybersecurity online safety basics. If you already know all this, that's great, but it's just good to get a refresher. And it's just, it talks about some core things that are really important for you to look at in terms of your online safety. So making sure that you use unique and complex passwords, long, unique and complex passwords, don't make it easy to guess. Using multi-factor authentication, we make sure that our clients have that for their accounts. Make sure you use it for your bank accounts, anything sensitive, really anything at all. If you can use two-factor, use the two-factor. Things like keeping your software updated. When it comes to, if you ever hear about, big data leaks that happen, lots of places like Google and Microsoft, they can have big data leaks. And sometimes one of the things that makes that safe again is because you need to install an update for that software. You need to get a patch. You need to be ready for when your defensive team actually releases an update to keep you secure. So making sure that you keep your software, keep your operating systems, keep your mobile phones updated, all that stuff, really important. And then just watch out for phishing and scams. When you receive emails about sensitive stuff, or if you ever get those texts that are like, oh, we missed your UPS delivery. Can you click on this link and then just to sign in and make sure, just double check what you're receiving stuff from. If there are characters that are out of place, scammers can get really good at mimicking the website with very minimal like letter changes. Be very careful about that. And one of the number one things that we notice in our practice is just like if somebody is trying to pressure you or make it happen now today, that's a really easy way to tell that it's probably not something that's in your best interest unless it's December 30th and you've got to do it for taxes. So it's like, pay attention on what the best interest is for the person who's reaching out to you, and just watch out for those phishing and scams. I like to use password managers for my passwords, by the way, because I don't like remembering a million different passwords. So using a password manager that can encrypt all of that data is really good. We use Dashlane at work. I use Proton at home, and there's a lot of other good ones. Bitwarden is a good option, but just go do some Googling and you'll find what you need. But that's it for our time today. We're 5 minutes over. So I hope you learned a little bit about portfolio managing. And if you've got any questions, you want to talk about anything, we'll stick around for a bit.